Hello and welcome everyone. Thank you so much for joining us today for our 2022 market outlook call. My name's Mike Martinelli. Our firm is Martinelli Financial Services. And again, we really appreciate you joining us today. Joining us in a moment will be Strider Elas of First Trust Portfolios. But before we get to Strider, what can we say about 2021? It's really been an interesting year to say the least. And as a few reference points, I want to point out a few things to start. As of Friday, December 17th, the S&P 500 was positive 24.7%, as well as the Dow Jones Industrial Average positive 17%. Both of these numbers, are outstanding, and we certainly have had our bumps in the road throughout the course of the year, especially with the return of volatility in the last few weeks. So Strider is going to give us some insights and ideas in 2022 as far as what to look for in the market. So without further ado, I want to introduce our guest today. And Strider, thank you so much for joining us. Strider Elas is a First Trust Portfolios senior economist. He's part of the First Trust economics team that is consistently ranked as one of the top economic teams in the industry by Bloomberg. So Strider, thanks so much for joining us today.
Hey, my pleasure to be with you, Mike.
So let's jump right into the hot topic of inflation. It's, really everywhere we turn today, whether it be the gas pump or the grocery store. What is the outlook from First Trust when it comes to inflation?
Yeah, we do not believe that inflation is transitory, as the Fed's been saying, and it's something that we've been very adamant about over the past year and a half or so. And the big reason for that is because it's not just a supply chain issue. In fact, I think the reason that we have supply chain issues today is tragically partly because of COVID. But I think more than the reason that we've gotten to where we've gotten to is because of the response to COVID, that not only have we been going through this pandemic, but it's really been a social media pandemic, which has caused this fear, which has made us have these shutdowns last year that would seem to be really accepted with little question. And because of that, we saw a huge increase in stimulus measures through both fiscal and monetary policy. And so when you look at how much money has entered the system in the economy, it's almost like nothing that we've ever seen. So if you think about really over the last year and a half, and you look at money outstanding in the economy, we look at the M2 money supply, it's grown since February of last year, kind of pre-COVID, by about 39%. I mean, it's been just massive growth like we have never really seen before. And so when you take a look, for instance, when you think about what the Fed has been projecting here, and you go back to December of last year of 2020, and what they were expecting for the end of this year in 2021. Well, if you look at their first meeting when they met in December of last year, they were expecting for the end of this year that inflation would be running about 1.8% by the end of this year. Well, obviously they were not even close to being accurate. And even as you look at the meetings that have since come from there, I mean, even their meeting before this last one that we just had a couple days ago here, but if you look back to the September meeting, they were forecasting for the end of this year now about 4.2% inflation year over year. And that was only a couple months ago there, and they were way off. In fact, now for their December meeting, they're now projecting 5.3%.
Right.
And so all this to say, and you can see moving down the line here, there's their 2022 projections, their 2023 projections, 2024. And so for 2022 now, they're projecting, they just raised it a little bit in December, but they're now projecting inflation will be running about 2.6% year over year in 2022. I think, again, just like we saw in 2021 with their major miss, they're going to be wrong again. And the reason is because this is not all due to supply chain issues. This is not transitory inflation, temporary inflation. This is going to be here for quite some time. Will it be as high as it is this year? I do not believe so. If you look at, for instance, if you look at why we're getting here, it's because of the massive growth that we have seen in the money supply. And as I said, that M2 measure, that orange line there, you can see it didn't matter what the Fed was doing really since 2009 when they started quantitative easing. The first three programs of quantitative easing, you can see on that blue line there, QE1, 2, and 3, it really didn't have much of an effect on M2 money supply, which is why we weren't worried about inflation over the previous recovery that we were in, or we did not believe that all these quantitative easings were having a big impact on the market for that matter. But when you look at quantitative easing 4, that's that big run up there you see at the end, and you look at what it's done to the M2 money supply, I would say that money is getting out into the economy. And here's a closer look just at M2 money supply, and you can see the dramatic growth that we have seen over the last year and a half or so. And as I said, M2 is up about 39% since February. We've really never seen anything like this in history. It's been growing right around 6% a year. And so what this means is that we have way too much money chasing too few goods. That's what leads to higher prices. That's what leads to inflation. And this is just from the monetary side. But if you look at it also from the fiscal side, from fiscal policy, that blue line there, that's government spending. And you can see really over the last couple of years, government spending has gone through the roof as we've added trillions and trillions of dollars of new spending to the economy. While at the same time, you look at revenues have held up. In fact, revenues are close to record highs. That's that orange line. But the difference between that blue line and that orange line, that's the deficit. And we're running multi-trillion-dollar deficits, and we'll probably see this for years to come. So all this to say that is inflation temporary? We just don't buy that. I think we'll continue to pick up some pace. It's probably not going to be as high as it was this year, where if you look just specifically at the consumer price index, for instance, it's grown. It will have grown for this year by about almost 7%. Next year, we're forecasting more around 4%, but still that's way higher than what the Fed's expecting with just a little bit over 2%. And I think inflation's here for the foreseeable future as long as there's so much extra money in the system right now.
Right. And like you said, obviously the Fed forecast for inflation is much lower than what we've seen so far, and First Trust expects that to continue into 2022. Now, going back to the Fed for a moment, and this somewhat transitions to our bond conversation in a moment, but the Fed has come out and said, okay, we're going to raise interest rates 3 times in 2022. In the opinion of First Trust, does that help slow down inflation at all, or is it continue to grow at the pace we've seen, like you mentioned, 4 to 5%?
Yeah, I think, inflation takes time to work through the system. And so even if they do start to raise interest rates, it's going to take time for that money to come out of the system. I think the sooner the Fed acts, the better off the economy over the longer term will be. The longer they wait, the more the bigger moves in interest rates essentially that they'll have to make. You think back to the late 1970s and early 80s. I mean, inflation got out of control because monetary policy was just ultra accommodative. And so it took somebody like Paul Volcker to come in the early 1980s and jack interest rates well above where nominal GDP was growing, which led to a short-term recession because he had to be so aggressive on raising rates. And so that would be my biggest fears if the Fed does not act quick enough, that eventually down the line to combat inflation, they will have to raise rates pretty steeply very quickly. And so I think the sooner they start to act, I think it was a really good sign in this last meeting that they completely changed their temperament, their thoughts on inflation, saying that this is transitory, to now saying that, okay, this looks like it's going to be here for a little while, and so we are going to be more aggressive with rate hikes. And as you said, they're forecasting now 3 rate hikes, and that falls into line with what consensus was already expecting before their meeting. And we now believe around the same. It's going to be 2 to 3 rate hikes, and they're going to start earlier, most likely, than what most thought. And a big reason for that is that this quantitative easing that they've been doing, they started to taper that off. Well, it's now going to be tapered faster, and so we could see a rate hike as soon as March. And I think there will be 2 to 3 rate hikes. I think the closer you get to the November elections, though, the less of a likelihood we're going to see of a rate hike around that period of time, because they don't want to have any influence really on the midterm elections there.
Understood. And that's all great information. And, again, inflation seems like it's here to stay for the short term. So transitioning over to the bond side of the conversation, and then we'll wrap up with the stock market outlook as well. But interest rates and bonds obviously go hand in hand. And as a quick refresher for everyone watching, interest rates going up means bond prices are going down. Now, with the Fed coming out and saying, okay, interest rates are going to go up officially 3 times in 2022, at least what they've said so far, what is the bond market outlook from First Trust? There's obviously, sectors of the bond market that are positively correlated to rising interest rates that will be better suited than others. But, again, from a big picture bond market going forward, what, is First Trust opinion there, Strider?
Yeah, I think in general, just as in this year, you want to stay in as short duration as you can in bonds or anything that has an inflation hedge to it, essentially moving forward here, because I do believe that rates will be rising here. And I think even on the long end, rates are going to be rising as well, which is going to hurt prices on bonds. So when we look at where things are going, our outlook for next year, we see inflation rising by between, let's just say 3.5% to 4.5%. And we see economic growth, real growth, rising by about 3%. So nominal GDP is probably going to come in somewhere around 6 to 7%, which is very, very strong. If you look at what other forecasters are saying, consensus right now is more similar to the Fed, where they're expecting faster real growth but lower inflation. I think we're going to see a little bit slower real growth but faster inflation. Either way, you get to about the same area for nominal GDP, where it will be growing around 6 to 7%. And so all that to say, I think longer term, the longer end of the yield curve will start to rise here, and with that, bond prices will be hit. And so I think the shorter duration you can be in, the better off you will be moving forward here. And I think this bull market that we've seen in bonds really over the last 30 years has come to an end, and you have to be a lot more selective moving forward here on trying to find yield, which is still very, very hard to do in this very, very low interest rate environment.
Well, exactly. And we have that conversation all the time with clients that, hey, where am I
Sure.
supposed to find yield and be conservative at the same time? The short end of the bond curve is really the only place to go, but it's not paying a whole heck of a lot these days. So, certainly for bonds, it's going to be a rough road ahead. As you mentioned, the 30-year bull market for bonds is really coming to an end. So let's transition over to the stock market and, the outlook going forward for stocks and equities for 2022. Strider, the question we get from clients all the time is, can the market continue to go higher? What's going to continue to drive us higher from the all-time highs that we've seen earlier this year? Now, of course, in the last few weeks, we've come off those all-time highs with a little bit more volatility. But I know First Trust has some specific targets for the S&P 500 in 2022. Could you share those for us and how you arrived at those targets as well, please?
Sure. Yeah, so what we use at First Trust is we use a capitalized profits model. And so basically what it takes into account is earnings over history, and it takes into account a discount rate, which we use the 10-year Treasury for. And so for us, what really matters, what really drives stocks over time is earnings, how well companies are doing. And so if earnings are going up over time, eventually the stock market is going to follow suit. Maybe it will be at the same time, maybe it will be delayed, maybe it'll be ahead of it. But earnings are what really drives the market higher. And what we have seen over the last year is that earnings have been booming. If you look at earnings for the S&P 500, they've grown by about 40% for this year in 2021. And in 2022, they're going to be very strong again, somewhere probably around 15 to 20% growth. And so earnings they're already back to sitting at record all-time highs. Companies are doing exceptionally well right now. And so when we look at our model, this is a picture of it over time. The blue line, the dark blue line there, that's the S&P 500. That's just the index. That's where we are. And that light blue line is our capitalized profits model. And so when that light blue line is below the dark blue line, the S&P 500, to us, that tells us that the market is undervalued. When it's above, that obviously means that it's overvalued. And so where we are today, putting in a 2% 10-year treasury tells us that the market is still substantially undervalued. If you put in the current 10-year treasury, which is what that light blue line is actually showing you, it shows that the market is still substantially undervalued when you put in a 1.5% 10-year treasury. Well, for our model right now, we're actually putting in a 2.5% 10-year treasury because we do believe that the 10-year treasury is going to move higher in the coming year. Our forecast for the end of 2022 is about 2% on that 2-year treasury, but just to be more conservative, we've put in a 2.5% 10-year treasury.
Right.
And basically the way this model works is we go all the way back to 1955. We look at every single quarter and we basically say, based on where corporate profits were in that quarter relative to the stock market and relative to where interest rates are, if that relationship held over this entire period of time, what would it be fair value today relative to this relationship? And so based on where corporate profits are today, well, actually as of the third quarter, that's the latest that we have. Based on where that relationship is today, with a 2.5% discount in there relative to how it's performed over history, what it shows us is that fair value for the S&P 500 to us is somewhere around 5,250. And so that's our end of the year target for 2022. That's about a 10 to 12% move from where we currently are in the market. And that's not to say that there's not going to be headwinds along the way. We haven't seen a 10% correction in a long time. Maybe we see one next year. I don't know. I think there's a lot more headwinds starting to form as we have fiscal policy and monetary policy, which are not going to be near as easy as they have been over the last year. But we do have an entrepreneur that's alive and well, and companies are continuing to innovate and create. And I think we're in this new productivity revolution from technologies that we've really seen just come online over the last couple of years. And so I think there's plenty to continue to propel the market forward in 2022. And so we still think it's going to be a good year, strong year for the markets. And as I said, again, what really matters is earnings, and earnings look like they're set to continue to be very, very strong in 2022.
Terrific. So again, that price target First Trust has set based upon your model here is 52.50 for the S&P 500 by the end of 2022.
Yep, and that translates over for the Dow to about 40,000 on the Dow.
Correct. And then if we go back to your 2021 predictions, your year-end target for the S&P 500 was what again? I'm sorry.
We actually raised it about mid-year to 5,000.
Right.
So we'll be probably, I mean, who knows where the next couple of days goes. The market's been very volatile, but it's going to finish probably somewhere around 4,700, 4,800.
Right.
What's interesting though about our model is it's not really there's been several years where it's really hit the nail on the head, which is amazing when you think about it. But that's not really I guess it is the goal of it, is to forecast it perfectly. But I think what this model has done very, very well over history is it's shown us when the market is over or undervalued. And what it shows today is that the market is still undervalued. And so we think it's a good time to continue to invest in U.S. equities and for at least the foreseeable future, as earnings are still very, very strong, and interest rates are still relatively low. When a lot of people ask, well, what would be fair value today? Where do interest rates need to go to get fair value today based on where earnings are? And we would have to see a 10-year treasury today of about 2.75% to see fair value on our model.
Right.
So I think there's a lot of room for this model. There's a lot of room for the equity markets to continue to improve here in the next couple of years. But I think there's a little bit more caution moving forward here than we've seen over the last year. Last year is probably one of the easiest years to forecast, as there's just so many tailwinds going for the U.S. economy and everything else, confidence coming back and whatnot. I think some of that carries over into 2022, but just not as much as we saw in 2021.
Well, the point I was getting to is that at the beginning of 2021, if I recall correctly, First Trust had one of the most aggressive price targets out there on the S&P 500, which I believe was about 46.50. Today we sit at right around 600 on the S&P 500. So your model was right on for 2021. Now, again, it's an inexact science where the model is really showing us fair value, as you mentioned. And it goes back to the point that, the other thing we've been speaking with a lot of clients about is what we call the TINA trade, right? There is no alternative being TINA to stocks right now. If you want to earn interest, if you want to earn upside, really stocks are the best place to go at the moment as well. And this model goes even further to show us they may be undervalued going forward as well. So that is very helpful. Any other points on the stock market outlook, Strider?
Yeah, I think it's going to be 2022 is going to be more, I think shifting more towards value. I think small caps are going to do very well in 2022 as well. And value within the value sector, small caps are going to do exceptionally well too.
Right.
When I look out over the next couple of years, I think you're going to want to be in companies that have strong balance sheets, that have strong earnings. I don't think you're going to want to chase. I know growth's performed exceptionally well. There's plenty of growth companies that have strong earnings as well. But I think those companies right now that have no earnings, that have just gone up substantially over the last couple of years, those are the areas that I try and avoid right now moving forward here, and focus more on those companies that are more household names that have performed well year in and year out over history. I think those are the companies that are going to really thrive in this environment moving forward.
Terrific. Yeah, we've already seen obviously some of that trade in the last few weeks. Not that we like to focus on the short term, but a lot of those names with no earnings and no profits, we've seen those names come down quite a bit in the last few weeks here of 2021. So again, Strider, thank you so much for joining us. This has been terrific. It's really given us some great insights into 2022 as far as obviously inflation continues to move higher. Bonds obviously have the end of their bull market coming, and as well, the stock market continues to grow in 2022. So we really want to thank you for joining us today. Any additional comments you want to add before we wrap up?
No, Merry Christmas to everybody. I hope you have a wonderful holiday season. Stay safe out there, and we look forward to a strong and healthy 2022.
Absolutely. Thanks so much for joining us, Strider, and thank you everyone for joining us on the call today. We look forward to talking with you soon, and have a great 2022. We'll talk to you soon. Have a great day.